All right, so to continue on from what we talked about with Unit 3 in personal finance, this is a continuation of Part 1. This will actually be Section 2. If you're following along through the actual PowerPoint itself, we'll be starting on Slide 11 and finishing off with Slide 20. All right, so now that we're thinking in terms of what's best for us, let's talk about options of where to put our money. All right, so this goes into financial institutions. All right, now there's 4 of them we're going to talk about today. All right, so the first one being banks, then credit union, then savings and loans, and then payday loan company. And here we go. All right, so these are some things that you got to consider when choosing a financial institution. What's the whole purpose? What are you trying to do? Are you trying to save money in a savings account? Are you trying to have easy access to your money at all times? Or are you trying to invest money? Essentially, who backs them? All right, these are banks. Okay, so for most consumers, banks provide a safe means to store earnings. Okay, you have your checking account and you're having your savings account. Generally speaking, when you have a savings account, what you put in is essentially going to be the same amount what you take out. All right, so there's some things that banks offer as services. All right, so you got direct deposit. A lot of you who do work may be eligible for this or may signed up for this. This is where you physically don't get an actual check, but the money that you make from work and labor, which is a factor of production, going back to Unit 1, this is where your paycheck actually goes directly into your account, your bank account. All right, they have check writing services. This is where you can write checks out to people or to yourself or whoever. You got debit cards, you got credit cards, you got loans of all sorts. You got your personal loans, okay? So let's say you want to take out a car loan or just a loan to pay off, a debt that you may have, or CDs, which is a certificate of deposit, which is kind of like putting money into a savings account. However, you develop more interest by purchasing a certificate of deposit. Okay, what it is you buy, it's literally a certificate. It tells you that you deposited X amount of money into a savings account. Now, the only thing about that, the downfall of that is once you put that money in, you cannot take it out if you want to make interest or more money back into it. Okay, this is like a legal agreement and a document saying that you're going to put money into a bank account and keep it there for X amount of time, which generally is at least a month. And after that month or that time period expires, your certificate will actually mature. Okay, and this is where interest rate will go up and you'll actually make more money off of it. Okay. And now we talk about home equity. Okay. With home equity, okay, this is where you actually purchase your home. Equity is basically the value of your home after deductions or after payments. What's your house essentially worth? Okay. And also you got, businesses. Okay. Banks have business accounts where you can, check and deposit, write checks, and have all of this in the same aspect. However, just in a bigger, larger business setting, as well as other services. All right. So in basic form, banks, they take the money deposited into the account and they actually loan it out or portions of these savings to people who request them. Okay. Now, how do the banks make money off of that? They charge interest on these loans. Okay. When they charge interest on these loans, banks make money. Okay. Now, it makes more sense for the more money being deposited, that's the more the loans businesses can make, or banks rather. Banks will offer very generous checking policies to influence us to actually deposit more money, because the more money we put in, the more they can loan out. And the bank only makes money by interest, okay? And when they serve interest, they may pay us back, and we just talked about savings. They'll pay us back a percentage for depositing money into their account. However, they will charge a higher interest to those who want a loan to make more money, okay? And they use paying us back a certain percentage as an incentive to keep trusting and putting our money into a bank, as they do feel as if it's a secure place to put your money. All right, now moving on, we got a credit union. Okay, this is very similar to a bank. The only difference is just they provide services, and I mean credit unions, to members. You have to actually apply to be a member of a credit union, and you get similar features. Okay. Now, in theory, credit unions, they should be able to have higher savings rates for deposits and also lower interest rates on loans, because if you think about it, it would help out both owners. And I'm talking about depositors and people taking out loans. So if you're thinking about a credit union, think about it as being more like a bank. However, you have to be a member of that credit union to receive those benefits and services. Savings and loans companies. All right. So we just talked about savings accounts, how they are relevant in a bank account or a bank and how they are relevant in a credit union. A savings and loan account is basically a focused, or it's organized like a focused bank. However, it provides a wealth of services. And, when we talk about savings and loans, guess what they emphasize in? Savings and loans. The savings, your personal savings, and then mortgage would be your loan, okay? Your house payments. All right. Now, the good thing about it is when you put money into a savings and loans company, it's not going to be easily accessible, okay? In a bank, you can freely take money in and out all you want, okay? Now, eventually, if you take money out of your savings account, some banks will actually charge you a fee. And there's some banks, like Bank of America, for example, you have to have X amount in your account, okay? If not, you'll get charged a monthly fee. I know for me, when I have Wells Fargo right now, in my account, if I swipe my debit card at least 10 times, okay, no matter what the charge is, I will avoid my monthly fee. If not, you have to have at least, I believe, $1,500 in my checking account. Now, with the savings and loan company, they focus just on savings and loans. That's a good thing. However, when you put money into savings and loan account, you will essentially typically get a higher savings rate, meaning that you're able to save more money and accumulate and accrue, more interest to actually get paid back more money for keeping money in a savings and loans account. Rather than a typical commercial bank, if you ever look at your bank account, a statement, you may get an interest payment of about 1 cent. And like I said, if you focus solely on savings and loans, people in, lenders and workers and businessmen and businesswomen of that area can focus just on that area. Okay. And they may be able to manage, these mortgage loans, other than banks, who may be willing or unwilling to take on these loans. There's some pretty little pictures for you. All right. So this is the last financial institution. This is known as a payday loan company. Okay. This is something I would like to see a big X, in stars, asterisk, highlight, whatever you got to do. This is something that you do not, repeat me, do not want. Okay. With a payday loan company, this essentially, if you are low on cash, okay, and you need essentially a loan, what a payday loan company is, they will essentially influence you to loan money through that company, okay? You ever seen those little signs that say, cash now, or like Lending Tree, or commercials like that saying, instant cash next day in your checking account within 24 hours, yada, yada, yada. Those are payday loan companies. And what they do, they will give you the money, find a nanny, 24 hours, 5 hours, however long it takes. You'll get your money in your checking account. However, they will charge you a fee to get paid back. So you look at this example. You got $50 on Wednesday, but won't get paid, or you need $50 on Wednesday. You don't get paid until Friday. To solve this problem, you may go into a payday loan company. They'll give you a small loan of $50. But in return, you got to pay a portion of your check. Okay? So basically, if you charge or loan out or get loaned $50 from a payday loan company, come Friday, hence the name payday is usually on Fridays, you may have to pay $55 back to that company. Okay? So they're going to charge you, payday loan companies, they're going to charge you large amount of interest to make their money back from you. So it's maybe great that you have $50 to pay, whatever bill in which you desire, but come payday, you're going to have to pay more back. So is it really worth it? No, it's not. All right, now going back to banking, there's a thing or corporation called the FDIC. This is the Federal Deposit Insurance Corporation. All right, this is the only organization that protects financial institution deposits by insuring deposits in both banks and thrift institutions. All right, there's a limit that a bank has of $250,000 per depositor, account owner, and FDIC insured bank. So basically what it's saying, when you put in your money into a bank, if that bank were to shut down for whatever reason and it's FDIC insured, you will get at least $250,000 of what you have in your account. Meaning, if you have $250,000, you're guaranteed $250,000 back. Now, if you only have $1,000 in your account, you're insured to get that $1,000 back. Okay, don't get confused with that. And the good thing about this FDIC, there is some sort of, reassurance and confidence in the U.S. financial system. Essentially, that where banks won't, tank and go out of business. All right, one more note before we close. All right, so, think about this. Imagine with your eyes closed. You ever heard a story when somebody robs a bank? Okay, and they say, one robber may rob the whole bank and was able to get $1 million. And another one got away with $40,000. Okay. What happened? Why is it that one guy made more money than another? Or got more money than the other robber? All right, this is called bank reserves, okay? This is a certain percentage in which a bank physically has to hold, okay? Whether it's in a central bank or within a vault, okay? I'm sure you've seen this in plenty of movies and videos, all right? So to take this into an extent, let's say the guy up here who got $1 million, okay? That usually it's about 10%, okay? So 10% of $1 million would be roughly 10 million, okay? Or, pardon me, yeah, 10 million. All right. And if we went ahead and got 40,000 of that, that would be roughly $4,000. Okay. This is called a bank reserve. A bank is required to have a certain percentage of whatever their assets is in their safe. Okay. This protects, the bank in case they need to loan it out for whatever reason. Okay. All right, guys. So that kind of wraps it up there. If you have any questions, don't hesitate to email me, tyler.pineda@hallco.org, or even shoot me a text on Remind. All right. So for the remainder of class, I would like for you to fill out the bank worksheet. The substitute teacher should have gave that to you. All you're doing is comparing two banks. You're finding two bank accounts, whether it be Wells Fargo and Bank of America, and simply filling down the sheet. If you got any questions, don't hesitate to ask. I'll put this video on Canvas, and the bank sheet's already worked out for you. They already printed out, so the sub's going to give it to you. You go ahead and look over that, complete it, and I would like for that to be done and submitted in my red basket in my classroom by Thursday. I plan on having a quiz over this unit, or Unit 1, Part 1, on Friday. All right. If you have any questions, don't hesitate to ask. Thanks, guys.